Hi. I will now walk you through a powerful analysis, the Dupont decomposition. To illustrate this analysis, let's assume you decide to open a small restaurant in a beautiful city, Paris. Your initial investment is $2 million. For now, let's assume that you have the cash available and that you decide to make the investment out of pocket. Take a look at your expected revenues, expenses, and the tax bill. Once everything is accounted for, you estimate a net income of $316,000. Hence, your ROE is 15.8%. So far, everything looks just fine. Even when all the ratios look just fine to you, your investors are pushing for higher gains. From the perspective of investors, the relevant measure is the return on equity, or ROE, which captures the percentage of return for each dollar shareholders have invested in the firm. To deal with this challenge, we can use a Dupont decomposition analysis. In Dupont's framework, there are broadly three channels through which you can improve the return on equity, or, in other words, the return investors will attain from your Paris restaurant. These channels are profitability, asset efficiency, and leverage. Let's take a look at each one of these channels and explore ways to enhance the ROE as requested by your investors. Improving the first channel, profitability, requires tons of work. You can do so by increasing prices, but if you increase prices, you will probably lose some customers. Hence, you can only increase prices as long as the increase in your markup is not canceled out by the lost revenues due to customers who cannot afford the new prices. You can also improve profitability by reducing your costs or expenses. You can do this through negotiations with your suppliers. Take a look at the first column. If you are successful in increasing prices and/or reducing expenses, your return on equity increases and your investors are happy. Your return on sales and the return on assets, which are other important metrics, increase as well. Improving the second channel, efficiency, also requires tons of work. You can do so by increasing asset efficiency. That is, you could bring more customers to your restaurant. Doing so results in an increase of your revenues. Moreover, as you increase your volume of revenues, it is likely that you will take advantage of economies of scale. Now take a look at the second column. If you are successful in increasing asset efficiency, your return on equity increases and your investors are happy. Your return on sales and the return on assets, which are other important metrics, increase as well. The third channel does not require any work at all. You can do so by increasing leverage, or in other words, by increasing the amount of debt you use to fund your investment. Since the ROE is calculated as the net income divided by the shareholders' equity, this metric will be mechanically improved given that the amount of money you are contributing is much lower. Take a look at the first and third column. In the first column, your ROE is 16%, which is the result of dividing the net income, $316,000, by the equity, $2 million. On the third column, however, your ROE jumps to 40%, which is the result of dividing the net income, $197,500, by the much lower value of equity, $500,000. You may have just noticed that your net income has decreased significantly from $316,000 to only $197,500, which is the result of the interest expense you will have to bear every year. Now take a look at the ratios. While the ROE did increase to 40%, the ROA decreased from 16% to 10%. This decrease in the ROA is the result of the much lower net income divided by the value of the initial investment, which is still the same, $2 million. Also, the return on sales decreased from 40% to 25%. This decrease in the ROS is the result of the much lower net income divided by the value of the revenues, which are still the same, $800,000. Long story short, an increase in the ROE is not always a good thing. You may be interested in learning the channel through which ROE is increasing. If a higher ROE is the result of improved profitability or efficiency, this is unquestionably great. However, An increase of debt will entail the burden of interest expenses and a higher likelihood of business failure. Although the leverage effect, which is increasing ROE through higher debt, may be convenient, you want to avoid overdoing it. Finally, the Dupont analysis shows exactly the same effects we have gone over, but through a math equation. In a nutshell, the ROE can be stated as the product of three ratios. First, the profit margin, which captures profitability. Second, the asset utilization, which captures efficiency. Third, the equity multiplier, which captures the degree of leverage of a firm. As you can see in the slide, if you look at the multiplication of each of these three ratios in detail, several parts cancel out, and you are left only with net income divided by equity, which is precisely the formula for ROE. I hope this video was helpful to clarify the Dupont decomposition. Please contact your instructor with any doubts or questions. Let's keep the good work.